Good morning.
Good morning.
Technicalities. I'm Jane Elliott, president of NIRI Atlanta, National Investor Relations Institute. And I appreciate you all being here this morning. This is our second annual fall conference, and we have another great lineup for you. And I want to thank all of our board members from last year because we got again won 2 awards for the small chapter, best overall chapter, and best special event for our golf outing that raised money for junior achievement. You're going to hear from Michelle Martin in a minute to speak on what we're going to be doing this year for junior achievement, just to give you a quick overview. But first, the board members from last year that were not able to make it, I'm going to read their names, and the ones that are here you can recognize. Gary Phelps from Spectrum Brands, Quinn Hudson from the Hudson Group, and Neil Welch from Business Wire served on our board last year, and I appreciate thank them. For those of you that are here, please stand when I call your names. Beverly Zerko from Bank of New York Mellon. Robert Worcester from Access. Jeff Dodge from Equifax. Martin Jarczyk from Virginal. And Isabel Jancy from Novellis. I'd also like to recognize one of our members from last year who contributed a huge amount to the success of NIRI Atlanta and actually created the start of this fall conference. And her name is Beverly Zerko. Beverly, come up here for a second.
Oh my God.
Beverly received the Individual Leadership Award from NIRI National, recognizing her efforts for all she did through our program efforts last year, and we really greatly appreciate her. Thank you. I'd also like to recognize our new board members this year, just to name them so you guys know who they are. Through a variety of terminus or job changes, we have several new board members this year. And those board members are Sid Jones from Genuine Parts Corporation, Sid, Bob Burton from IR Squared, Bill McCarthy from Nina Paper, Jason Zigran from Allscripts, and Lisa Petroff from Business Wire. So as you can see from the members we have, we're going to have another great year, great programming, and I hope you all pay attention to our announcements throughout the year and join our different programs. Once a month, third Friday, at my jam and Bobcat. It's typically a breakfast. I think we're going to do lunch this year in February. So before we start, I want to tell you a little bit about what our topics today. All of us in this room interact with multiple folks internally and externally, and a lot of different perspectives that we have to constantly shift and be able to deal with and think quick on our feet. So today we're going to hear perspectives on the hot topics from prominent CFOs. And we'll also have a panel of experts covering the changing regulatory environment and what that means for us when we're trying to make sure our companies are in compliance, our executives are in compliance. And finally, we will hear from the president of Global Payments, Jeff Sloan, who will speak on what life is like in a public company. Jeff's background was a fintech M&A guy from Goldman Sachs. He was the top person that the industry went to basically to get a deal consummated and done. So he has a very unique perspective because he sat on the outside looking in, working with public companies, and now today he's part of Global Payments. And he'll speak at 11 right before the lunch, which I want to invite all of you to down in the cafeteria, the Bay style, great chance for networking. So also I want to show you there's an agenda out there that you must receive at the door. In that agenda, we have the speaker biographies. We also have our sponsorships. And I want to, before we can begin, this couldn't have been possible without our sponsors. So I want to recognize them and thank them for all of their contributions. First, I want to thank UPS for providing us this wonderful facility. And we all know that UPS is the world's largest package delivery company. Is there anyone here from UPS? Kurt Kuhn is the CFO. We're going to hear from him momentarily. So thanks, Kurt, for UPS. Labrador is also here. Is Dwayne in the room? Labrador is a full-service financial communication agency that actually can take a company's 10K and scale it down by more than 25%. And they have a table outside. So I encourage you, if you need to consider having printing service for 10K, want to reduce your paper, to check out his table and speak with him. We also have Phoenix Advisory Services at the table out there, and they're a proxy service company. Is there anybody from Phoenix here? Please know and go visit him, and he can help you out there. Bank of New York Mellon Shareholder Services, we heard from Beverly. They're a big sponsor this year, and I think we all know that they do a variety of shareholder services and proxy solicitations and all sorts of things. So please see Beverly if you have any questions on that. Prescott Alexander is also here and a big sponsor. Doing great. Thank you. Prescott offers print online communication services, design, and reports. So again, visit with Prescott, check out their website so you can see what they can offer. And finally, JCS Media, which is Joseph Stanley standing back over there. He has provided a host of services to NIRI over the years. And I actually have a little, in effort of time, I'm not going to have this come up, but Joseph, I have a little thank you for you, for all of your work. So I want to give you and finally, I'd like to recognize Bill McCarthy and Jason Sigron, who are our co-program chairs this year for NIRI Atlanta. And Bill and Jason have done an incredible job at setting this up. So thank you very much. A few housekeeping items. The conference qualifies for 4 CPE or CLE credits. You can see Sally Payne, who is at the registration table at the end of the conference to get your certificate. Next month's program is October 15th at Maggiano's on communications at 7:30 to 9. And check out our NIRIland.org website for further information. There's also, I want to remind you, we're not allowed to have food and drink in the auditorium per the UPS requirements. So the break room is down at the end of the hall to the right that has refreshments. And we'll take 2 breaks, and I think that's highlighted on your agenda. The program is being webcast and recorded, so there are going to be a couple of mics around the room. Please make an effort to ask the question in the mic. Please don't forget to turn off your cell phones. We appreciate that to be on silent. And finally, we have our May 12th and 13th is going to be our golf outing. May 13th is a Friday. We're going to do similar like what we've done the last few years up in Cobblestone, which is a beautiful public golf course up in about 75 North. But in addition, there's a lot of us that don't play golf. This year we decided we'd have a silent live auction the night before, a cocktail party type thing to raise additional money for junior achievement. And we will have more information on the silent auction as we go next month or two, so you guys can start thinking about that. And if you have any goods or services to donate, please let Jack Dodge know, and he's coordinating. But before we go to our first speaker, I want to introduce Michelle Martin from Junior Achievement. She's going to give you a couple minutes lowdown on what Junior Achievement is about.
Hello. My name is Michelle Martin. I'm the Director of Special Events for Junior Achievement of Georgia. And Junior Achievement is a global, we're international, we're a global economic nonprofit entity. What we do is we inspire and prepare students to succeed in the local economy. We do that through financial literacy, workforce readiness skills, and programs based on entrepreneurship. And we can't do it without the support of people like you. NIRI, through the golf filing, donated almost over $6,000 to our organization, and it helped us exceed our goal of serving over 130 students throughout the metro Atlanta area. This year we're trying to serve 140,000, so we really appreciate your support. And we do our programs through volunteers coming into the classroom to give a real world experience, as well as the curriculum that is correlated to the statewide, nationwide curriculum and standards. And they go into the classrooms and facilitate our programs and hopefully invest and involve and inspire students to be global citizens and to be successful regardless of their past in life. We really appreciate it, and we look forward to partnering with you all again this year. And if you'd like, if you have any other questions, please come visit me in the lobby. Thank you.
Thanks, Michelle. Now, without further ado, I'd like to open up today's program with our first prominent CFO. He has over 30 years of business experience, serving in a variety of roles, and one, interestingly enough, was helping to take this company public, the largest IPO in the 20th century. He is the CFO of UPS, Kurt Kuhn. Kurt?
Great. Thanks a lot. Good morning, everyone, and welcome to UPS's corporate headquarters. We're glad to be able to host you. My only regret is that, unfortunately, I scheduled this day with all kinds of meetings, so I won't be able to sit in and hear some of the discussions. You know, because IR has always been a special place in my heart since I learned the baptism by fire from IR by walking into the office of the CFO one day in August of 1999 and being told two surprising things. Number one, that UPS, which was a private company and had been for 92 years, was going public. And number two, that they wanted me to be the investor relations manager, because we never had one before. Figure out how do you take a company public. So it was a terrifying experience, but it was also incredible to take a company that has this much history and be able to create an external voice. And you can see that we still relish and celebrate our history internally. Actually, these posters are from our latest management report back conference, in which we talk back about some of the struggles that the company had back in the 30s when the Depression hit, and drew some parallels to the kind of things we have to do today. So we continue to celebrate and draw links back to our history for our internal messaging. And frankly, we also like to use that for our external messaging to help the market know that UPS has seen 21 recessions in its history. This one may be a little worse than average, or a lot worse than average, but this too shall pass. IR is a unique issue at UPS because of our very long history, and also the fact that one of UPS's keys to success as a private company was the vision of the founder that began sharing equity in the company very early. He began to offer equity in the company in the 30s, believe it or not, in an attempt to basically keep the company private. And that program grew to where by the early 50s, all of our management people were receive every year a significant amount of their compensation in stock. UPSers, in effect, were cash poor but stock rich, and the company distributed compensation as a way to reserve funds and grow without having to go to public markets. So we ended up with a very long history of thousands of management people with deep shares. So we had an investor relations program that was all internal, and it was all about being a partner in business. So actually the hardest thing about IR when I first came in was helping the 100,000 share owners that we had that were used to being a private company learn how to live with the volatility and sometimes irrationality of public markets. That was by far more challenging than trying to help Wall Street understand the great financial outputs of the company. It's actually, I was thinking about this before coming in, 11 years to the day almost, plus or minus a couple of days, when the sell side and buy side came into this room in a pre-meeting before we actually launched in November of '99. So it's bringing back some memories of me stepping up to a similar platform here and taking the investors for the first time through the history, the business model, the financial outputs, and prospects for UPS. It's been an interesting history. The IPO was well received. There aren't many times that a 92-year-old business that has the kind of market share, market cap goes public. Although the downside is we had such a great lift at the IPO that the stock kind of traded sideways for a lot of years. So if you look back over 11 years, the stock's up a little, but not much. And as I was talking before the meeting here, really most of what investors had to show is the dividends that we paid over the last 10 or 11 years, and that seems to be a recurring theme in IR meetings these days in an environment where the outlook for the future is cloudy, that there's a risk of us being in this new normal, that certainly the issue of paying dividends to at least kind of guarantee a return seems to be a bigger issue. UPS's model for IR is a little different than most. We really put a big emphasis on bringing company veterans and executives into IR. When we first went public, we did have a couple of IR professionals that we brought in, but really since then, we've really relied on taking good managers and rotating through the IR group. We find it works well for us as a company that has a deep history to leverage that experience. In fact, the 3 IR managers that are in the room today, Keith, Elva, and Barbara, most of them have 20 years or more with the company. So it's a great asset for us to be able to take these very seasoned, very knowledgeable people, teach them a little IR, teach them the do's and don'ts, and then let them testify in the first person about the company. And it's a great way to reassure investors that the company has a great continuity. But that's enough about UPS, I guess I feel today as though I'm finally qualified to be a good IR guy. In 1999, I wasn't ready. I'd never been on Wall Street before. I didn't really have any preparation in communicating externally. I survived for the 4 or 5 years I was in there. But the interesting twist in my career, which has been primarily engineering and finance, was after doing the IR job, I actually moved in and ran sales and marketing for the company for 4 years. And moving into that job, I realized how much IR is like a good solution sales job, where you develop long-term relations, you find the attributes of your product, you understand your customers' problems, and see whether your products can meet them. So after spending 4 years running sales and marketing, and then coming into the CFO job, I now feel like I really can do a heck of a job at IR. Although Andy Domi, our VP of Investor Relations, tells me to stay away. But IR really is this blend of disciplines. It's a little bit of sales, but sales in the positive sense of understanding your customers' needs. It's certainly a lot of finance, because you've got to understand the language of finance. It takes great political skills, relationship skills, because typically you're building long-term relations. And unlike some sales jobs where you close the deal and you walk away, you guys have never done making a sale. You may get that sale initially when an investor decides to take a position in your company, but then after that, it's a long-term relationship to build, to to sustain the trust and keep the transparency. So I don't envy you guys. I know it's a challenge, and clearly in today's market where nobody has a good feel where things are going, it is important that IR find a way to reassure investors that no matter where the economy cycles, that your companies have got a plan to manage through. Because the sell side and buy side, frankly, are the most humble that I've seen in my career. They really don't know what's going on. Whereas I can remember in years past when markets were booming that they feel like masters of the universe. But that's a great opportunity, I think, for IR executives because you really can help your customers manage through, help them understand why your company makes sense for their portfolios, and also be able to talk frankly and manage expectations. So anyway, you guys got a lot of stuff coming in today. I'm going to be a big focus on regulation. At the end of my IR term, the big issue was Reg FD, which some IR professionals thought was going to be the end of the world. And frankly, I liked it because it took a little bit of the heat off for some of the jawboning that used to occur 10 years ago. But today there's a whole new set of issues. Dodd-Frank, Consumer Protection Acts, trying to help your executives navigate this and stay in sync with laws and regulations continues to be a challenge. So anyway, welcome to UPS and good luck going forward. IR is going to continue to be an exciting and critical role, even more so in an environment where the economic uncertainty continues. So thanks a lot and have a good day.
Good morning. My name is Bob Burton. I'm the principal of IR Squared, and this is the CFO panel. Thank you very much for coming and joining us today. We have about an hour. Our agenda will be as follows. We'll talk about 5 topics up here: the economy, equity markets, M&A activity, GAAP versus non-GAAP reporting, and valuing IR. We should be able to cover all aspects of those in about 40 minutes, I think, without too much trouble, followed by 20 minutes of Q&A. Let me introduce our panelists first. On my left is David Mangum. David Mangum is Executive Vice President and Chief Financial Officer of Global Payments, responsible for all financial operations of the company. Previously, he served as Executive Vice President and Chief Financial Officer of CheckFree Corporation. CheckFree was acquired by Fiserv in December 2007. David represented CheckFree during diligence negotiations and subsequently served as Executive Vice President of Fiserv prior to joining Global Payments. David's been named one of the best CFOs in America by Institutional Investor magazine. Global Payments is a leading provider of electronic processing services, handling billions of payment card, check, and e-commerce transactions annually for over 1 million merchant locations worldwide. Their clients range from large multinational corporations to small to mid-market merchants and cover a diversified base of retailers, restaurants, automotive, and professional services, utilities, healthcare, lodging, and gaming establishments, and government agencies in the U.S., Canada, Europe, the U.K., and Asia Pacific. Global Payments came public in February 2001. Their annual revenue is $1.7 billion. The market cap is $3.3 billion on 80 million shares outstanding. They have 372 institutional holders and are followed by 28 analysts. Their investor relations officer is Jane Elliott. Next to David is Jerry Nix. Jerry is Chief Financial Officer and Vice Chairman of the Board of Directors of Genuine Parts Company. Jerry has been with Genuine Parts since 1978, or 32 years, and for those who haven't been around that long, Jerry was one of the founders of the Atlanta NIRI chapter, I believe.
Thank you.
Prior to that, he was an accountant with Ernst & Young. Founded in 1928, Genuine Parts is a service organization engaged in the distribution of automotive replacement parts, industrial replacement parts, office products, and electronic materials. Its products and services are offered through a network of over 2,000 operations located across the United States, Canada, and Mexico. Genuine Parts' current market cap is $7 billion on an annual revenue of $10.5 billion. They have 158 million shares outstanding, 724 institutional shareholders, followed by 12 analysts. Their investor relations officer is Sid Jones. Next to Jerry is Steve Fisher. Steve is Senior Vice President and Chief Financial Officer at Novellus. Novellus is a world leader in aluminum rolling and recycling. Through industry-leading technology, Novellus produces premium sheet and foil for high-value markets globally, including can sheet, automotive, and industrial electronic products. Novellus is also the largest recycler of aluminum cans worldwide. Novellus is a subsidiary of Hindalco Industries Limited, part of the worldwide Aditya Birla Group. Novellus has trailing 12-month revenues of $9.2 billion and $1.3 billion in publicly traded debt. Prior to his appointment as CFO in May 2007, Steve had been Vice President of Strategic Planning and Corporate Development at Novellus since 2006. Among other activities, he was the chief architect of Novellus's corporate strategy and managed the discussions that led to the acquisition of Novellus by Hindalco. Prior to joining Novellus, Steve spent 13 years in the energy sector, holding significant roles in finance and accounting, strategic planning, and business development. He's a CPA. Novellus' investor relations officer is Isabel Jansen. Starting with the economy, it's great news that the recession has been over since 2009. I hadn't noticed that. A couple of economic data points. I read in the Wall Street Journal last week that household income fell 4.8% between 2000 and 2009, the worst performance in half a century. Also last week, although the recession is over, the University of Michigan consumer confidence dropped to a one-year low of 66.6. U.S. unemployment is at 9.7%, including my daughter doing an unpaid internship in Washington, D.C. Gross domestic product for the June quarter advanced a meager 0.4%. And at the same time, there's still a lot of cash on the sidelines, both in private equity and among corporations who saw profits improve in the June quarter by nearly 6%, I suspect largely on cost cutting. We have three deeply experienced CFOs here with unique insight into such core areas as the global auto industry, electronics, technology, global credit, and cash flow. What are your takes on the current economy and the outlook for the next 18 months, U.S. and abroad? Should you invest or conserve? And what are the key trends for businesses, large or small? Let's start here with David and go down the list.
Does your daughter's unpaid internship count as underemployed or unemployed?
You know, I don't know. I could call it slavery.
Okay, fair enough. The global payments, we process credit and debit card transactions on behalf of merchants and consumers around the world. So we operate in 23 countries. We have a bit of a view of the market. I guess what I would say is to the economy at large, when we were building out our budget for this year, where May year-ends are kind of a weird outlier here, and looking ahead to the next 2 or 3 years, and you mentioned the next 18 months, Bob, we don't see a sign of anything getting better or materially worse for the moment. And I say that only from the perspective of watching consumer spending trends on a global basis. Literally no sign of it getting better. There are signs occasionally, I suppose, of it getting worse, depending on which market we're talking about. Worse in the UK, worse in parts of the US. For us, we're in a bit of an odd situation. For us, that actually means invest, not conserve. We have a unique opportunity, we think, to grow on a global basis and expand. So I think the answer to your question in terms of what to do depends on your market share, your market position, the position of your competitors. Our competitors happen to be a little more troubled in terms of leverage. Our largest competitor is heavily leveraged, which we think gives us a nice 2-year runway to actually expand, invest, and acquire toward a bigger global footprint. But again, I think it's facts and circumstances. But certainly at a consumer level, from the data we see, things don't seem to have gotten worse in the last 6 to 9 months, but our outlook is it's not about to get better anytime soon either.
Bob, Virginia Parts Company, I think our situation is a little bit different. We're strictly a North American company. We sell expendable replacement type items. And our business is good this year. And the indices that we follow, miles driven in our automotive business, the industrial production numbers, those are leading indicators for 6 to 9 months. So we're going to be in good position for at least that. What we hear from our customers is that business is good. And so we expect, I guess the hot buzzword today that everybody's using is cautiously optimistic. And that's basically where we are. We are investing, and we like to make acquisitions. We expected to make more than we have at this point. We thought with private equity money having disappeared that there would be more available. The tax law changes that are coming up. We buy privately held companies. We don't buy any public companies, and we thought we'd have more opportunities. We did 5 last year, and we've done 2 this year. So I think from our perspective, investing-wise, we're going to invest conservative. Your comments about cash on corporate balance sheets, we have a lot of cash sitting there, and the returns you're getting on that cash today are less than 50 basis points, and so we feel to invest in acquisitions is a good strategy. We're also very active in a share repurchase program, and sometimes the best acquisition you can make is buying your own company, and we feel good about it because we've been doing it for a long time. But I think our feeling is that the economy is probably going to continue as is. There is this overriding concern about the consumer not buying, and the lack of consumer confidence is going to stall it again. And if that happens, that's not going to be good for any of us. But none of the indices we track show that's going to happen.
Good. So a little bit about Novellus. We operate in 11 countries, very global operations across Asia, South America, Europe, and North America. And we've seen differences in each region over the past 2 years. Certainly, Asia, with all the stimulus, is continuing to grow and growing quite considerably for us, as well as South America is. So when we think about investing, those 2 regions are areas that we are very focused on finding some investment opportunities in. I've announced 2 quarters ago that we put $300 million into South America, into a facility there to grow our capacity. When we look at North America and Europe, it's a little bit different story, and you kind of have to understand our end markets as well. 60% of the North American end market is can. And can for us is very recessionary resistant. So it's a nice base product that we didn't really see a tremendous fall off during the recessionary period, and helped us kind of take advantage and stabilize over the past 2 years to build our liquidity up. The other significant components is then auto and construction. And with some of the stimulus coming in, specifically with the auto, we've seen demand kind of come forward quicker than we thought we would, both in the European auto market and in the North American auto market, which has been good for us. As we look out, over the next 12 months, though, I think we're very cautious in looking at North America and Europe. I think we don't see a tremendous amount of improvement in those 2 regions, but I would echo that we don't see a lot of pullback either. We don't see the signals that look to show double-dip recessions or anything like that, but we're not going to look to invest in those 2 areas. While we continue to build liquidity, agree with Jerry that we will find opportunities to invest, but it's going to be more in the emerging markets where we see more double-digit growth opportunities for Novellus. So kind of mixed across the world for us.
So if I sum this up, then generally speaking, not a lot of change in the current economic environment, but none of you seem to be finding it to be all that fearsome either. Your businesses generally have opportunities. Generally, I hear all of you saying selectively investment's the right thing to do. What makes the economy globally or in the U.S. begin to improve? What's the next trigger point that you're looking at to make things change? And Steve, we'll start with you.
Sure.
Come back this way.
The signals that we're looking for is consumer spending and increasing consumer spending in the more developed areas of the world, which we don't see in the near-term horizon. With unemployment, still close to 10%, as you highlighted, it's going to be very, very difficult for, I think, the North American specific and European markets to recover at any rapid pace. The other thing that we would consider is just the overall leverage that businesses have as well as governments have, and that deleveraging effect is going to take some time, and that is going to stymie, I think, growth. So again, not a lot of negative signals, but certainly ones that we don't see a rapid recovery coming in those 2 areas of the world.
From our perspective, I agree with Steve. Until consumer confidence picks up and start buying product, and that's not likely to happen until unemployment drops, then these industrial production numbers and PMI numbers and all of those, they'll start to tail back, because I mean they're building the product, but if the consumer is not going to buy it, that back up the system. Last week we were up in New York at a Goldman Sachs conference, and the common thing that everybody's talking about is our business is good and we feel good about it. And then the next question, are you hiring? And people said no. And then what are you waiting on? Well, there's so much uncertainty. And what will it take for you to start rehiring and in order to bring these unemployment numbers down? And nobody had an answer to that. And maybe the changes or non-changes that will come about with the election will have some impact. But until the consumer confidence level changes, I mean, you can manufacture all the product you want, but if they're not going to buy it, then we're not going to have the recovery we need. I think Kirk said it earlier, this might be the new norm, unfortunately, for us for another year or so.
David?
I agree with what both Steve and Jerry said. It's about consumer confidence and consumer spending. You still see consumer spending. You see even some modest growth in Asia. It relates to stimulus and a number of other things on a per capita basis. But until consumers come back and spend, that's going to be tough to see anything materially changing.
Let's turn for a minute to the equity markets. Gold is at record levels, over $1,200 an ounce. The cost of fixed income is very low. The average yield on U.S. investment-grade bonds is an all-time low, 3.7%. The S&P is somewhere around 1130, 1140, which, although it's its highest level since May, is about in the middle between the market high in May of 08 and the market low in March of 09. At the same time, liquidity, or the dollars moving through the markets, is being driven increasingly by volatility, which makes people wonder whether the million shares that traded in their stock yesterday was really a million shares or whether it was one share traded a million times. For the past decade, it's also been getting less popular to be public in the United States. The number of exchange-listed companies has declined 40% from a peak of 8,800 in the late 90s to 5,400 at the end of 2008, even though listing requirements have been relaxed. Given the alternative sources of capital that you all have available to you, how do the equity markets look to you these days, particularly with regard to large and small market caps? Are the markets doing their job of providing growth capital for the economy? Asked another way, are public markets worth the effort these days? Start with David.
They're worth the effort these days. Let's see, we're talking to 50 IR professionals. They're absolutely worth the effort. Yes, thank you very much for your effort. We appreciate it. The three of us probably particularly appreciate it, since we're one step removed from the grind you guys deal with day to day. I still think they're worth it. I think that at the end of the day, there are only so many sources of liquidity. If you look at deals like the Green Dot IPO, there's an enormous amount of appetite for growth or for innovative names in the market. That doesn't make it fun to be public by any stretch of the imagination. But there are only so many other choices. The debt markets for folks like us are extremely attractive and hot. So it's the right source of liquidity for companies like ours, I'm sure, at this stage. Although they make an interesting situation for us because now private equity firms can lever and buy things more expensively than I can, which is a strange, kind of almost troubling thing when we get to M&A. I suppose we'll talk about that, Bob. But I still think they're a terrific source. It's tough to be public, but there really isn't that access to capital anywhere else for some of the enterprises you see right now.
Mm-hmm. From our perspective, we've been public since 1948, so we don't go to the equity market to generate capital. We also don't have a public debt rating, so it's a little bit unique and it's difficult for me to address that. But in general, today, debt is much cheaper capital than equity. But how long will that last is anybody's guess. And longer term, you could lock up, and that's what these private equity firms, they have a lot of cash today, but they also have a lot of access to cash at very low rates, and they're just sitting on the sidelines waiting to see what happens. And I think that's why we haven't been able to make more acquisitions ourselves, is because people are waiting for that private equity money to come around and pay them a much higher premium than we would pay them. I'm sure that must be you, Bob, because it can't be.
I think I may turn mine off and just speak up. I'll be fine.
But, from my perspective, it's certainly worth it to still be public. But the last few years would tell you if you had your druthers, you'd rather not be public and go through all the grief and expense that a company has to go to. through. But, and that's why a lot of folks are going over to Europe today to go to the equity markets as well. So,
yeah. So I guess in general, I would agree that it is a very, very valuable liquidity source for a company. It probably depends a little bit on what your strategic opportunities and growth ambitions are. We currently at Novellus are not public equity. We're private, held 100% by a company in India that is a public company there. So it's not necessarily as a holistically throughout the system that we're against being public, but I think it comes at a cost of capital. And currently, we have about $2.8 billion of debt. It's very cheap. It's a very strong source of capital for us that we're going to use for now as we think through growth opportunities. But as we continue to try and hold our position in the space, I think it is an option that we will always consider as an opportunity to grow the company. We do have public debt, so it's interesting when you start to think about the regulations. There are only limited sources of capital out there, and ultimately, if you're a larger company, you're going to need to start to tap public sources of capital. And so we have, somewhere between $1.4 billion of bonds that trade publicly, in a term loan of about 1.1 that also trades fairly publicly as well. And because of the bonds, we have all the same reporting requirements that a public equity company would have. So we've already taken that step outside of the proxy rules, which we'll talk about later. We've taken that step to kind of step into that market. And so from a public reporting standpoint, and Reg FD and all that, I don't think that's something that concerns us as much as ultimately making that decision based on a cost of capital because of, as David and Jerry both said, it's very, very attractive right now on the debt side.
Let me follow up with two aspects of public equity, dividends and buybacks. And Jerry, start with you. I think you pay a dividend, if I'm not mistaken.
Yeah, we're fortunate, and today our stock's up 17% year to date, and I think we're up about 25% off a 52-week low. But the reason for that is because dividends are popular. I mentioned we had gone public in 1948, and we've paid a dividend every year since we went public. And we're in the top 4 or 5 companies that have increased the dividend. We've increased it for 54 consecutive years. Our dividend yield stays about 4%. So yeah, from an investment perspective, that's what we're known for. We're not going to ever move up 15 to 20% in the stock price in a year. We don't normally go down, 2009 being the exception. We don't normally go down that much. But from our perspective, that's what our shareholders expect. That's the kind of shareholder we want. And we have started really going into Europe because, in our opinion, that's the last bastion of true investors anymore. And that's what they look for as a dividend, and they've started buying our stock, and they're long-term holders. They don't even ask questions about the quarter, which is a pleasant thing. And but the dividend for us is key, and that's what our shareholders look for.
Did you have any discussion internally about not having a dividend at any point? Has it been controversial? Because it hasn't been popular.
Look, I enjoy working at Genuine Parts Company, and if we ever had a year where we didn't increase that dividend, somebody else would be in my job. And, so we avoid having that discussion.
Okay. Steve?
Yeah, we have a unique situation in that we were acquired by this company almost 4 years ago, and we've left a very attractive capital structure on the debt side in place. And because of that, it limits the ability to pay dividends upwards because of some issues we had when we were spun off from our previous parent company. So we have not paid any dividends over the past 4 years. But certainly as a private company, that cash flow is something they're going to be looking for as we think about refinancing here in the future.
Mm-hmm. And if you had excess cash, as you generate cash is one of the uses, you can't do a stock buyback, but paying down debt is part of what you think about?
Yeah, the debt's cheap. And so I think the first thing we want to do is look for strategic opportunities. And so I think that's where our focus is right now. The last 2 years, we've built a lot of liquidity up. And I think that was important to stabilize the balance sheet in general. But now I think the first area that we're looking at is strategic growth opportunities versus paying down cheap debt.
I guess I'm going to give a very different answer from Jerry, but for the exact same reason. So different investor bases. Our investors invest in Global Payments for growth. We have the 372 institutional investors that Bob described are growth or GARP. No matter how you slice it, that's really what we have, index funds, things like that. So when we think about a dividend, we really stop and say, okay, what's the first and best use of our capital? And for us, it's likely global expansion to some of the same developing markets Steve was describing earlier. Beyond that, we think about a buyback for either moments you get clipped or on a routine basis to offset dilution just for a pure sort of balance sheet perspective. But we haven't gotten ourselves to the dividend conversation yet. Often that signals something to your sort of growth and technology investor base. So we're not there yet, although it's an active conversation. If you sit in this kind of economy for a long time and you say to yourself, they invest in you for growth, you have to sort of assess at least where you are, relatively speaking, on growth. We'll grow the bottom line 10% organically this year. That's a growth stock, certainly in a bad economy, but we always force ourselves to at least have the debate as to whether or not the investors would support it and which investors would, or would you turn over the base, et cetera, et cetera.
As a part of this conversation, the concept of merger and acquisition M&A activity has come up a couple of times. Let's go to that for a minute. All three of your businesses have either made acquisitions or been acquired as part of long-term growth strategies. The number of M&A transactions so far in the September quarter is about 5,000, which is the highest since the third quarter of 08, but well below the peak of 8,500 in Q2 of 07. Deals thus far this year are valued at over 1.4 trillion. About a third of it is here in the U.S. The rest of it is overseas. Given the cost of capital, is M&A strong and getting stronger? What are you seeing in your industries? M&A is obviously an important part of all three of your strategies. How do you see activity in that area over the next year or two? Start here and go that way.
Okay. We see M&A in our sector being very hot. It's obviously driven by the same things these guys are talking about. It's the cheap debt at the end of the day that's driving even new players into our space that we haven't seen for years. We've seen enormous multiples, up to 16 times EBITDA for properties in our space. They obviously are attracted to the recurring revenue nature of the business, wed to this sort of cash to plastic trend that a company like ours would ride. We do see a market, though, right now where the private equity guys looking at our space can actually pay more than we can, which is challenging. So a lot of the deals are going to private equity. There is still a point as a public company where you stop and you can't pay every multiple out there. But it is very hot on a worldwide basis, with a lot of focus, I think, on what Steve was describing earlier, which is how do you get more global reach, particularly in developing long-term growth markets, which is really interesting to watch. Those are tough properties to find. But when you do, there's a real battle for them right now. Mm-hmm.
I agree with David. The M&A market is hot. Now, keep in mind, we only look at privately held companies, but the private equity money there, and we're a long-term strategic disciplined buyer. And so we walk away from deals. And the folks that have these companies that they want to sell now, they don't want to include the last 2 years in their earnings adjustments, and so we're going to pass on that. But there's a lot of companies that are now coming back from the previous private equity binge on buying companies, and now they don't have an exit strategy. They've been through one private equity firm selling to another private equity firm where they paid much higher EBITDA multiples than we would pay. And so we're just going to bide our time, and I think as we get a little closer, we've got several in the hopper right now, but we're waiting for the owners of those companies to decide what the capital gain tax laws are going to be, and then they'll come back to us hopefully. But it is as hot now as it's been in a long time.
Yeah, I agree. We've seen in our industry a number of opportunities come up over the past year. 2 years ago, almost dead. This past year, there seems to be a tremendous amount of different various assets coming on the marketplace. On inbound calls, we get calls all the time from private equity guys looking to put capital to work. So again, it comes back to, I think they can't find the right place to get a return, and so now they're looking to actually own our assets as well. So we get a tremendous amount on just inbound interest on our assets as well. I think, from our perspective, we want to be very prudent when we think about M&A, and be very, very much more risk adverse from a due diligence standpoint, not necessarily from a return standpoint, but what we can't afford is to go in and miss something in the due diligence phase and have a big loss come from something we were to buy. So I think, what we've understood over the past 2 to 3 years is, you got to ensure that you have that liquidity, that balance sheet support, and be very diligent before you go in and buy. And I think from that perspective, things will move a little bit slower, but there is a lot out there on the street being shopped.
Disagree with me if you like, but I have generally thought of private equity as not being the people who would pay the highest premium for something. I've thought of them as more opportunistic. They'll take a small business that doesn't have good earnings and grow it. They'll take a business that's in trouble and turn it around. Is this an unusual circumstance, having this amount of private equity getting in your way in terms of trying to get the proper valuations for your acquisition?
I don't think it's unusual. I mean, it's not 2007 either. No one's levering to 10 times to buy something, but for them, if the math works, so if you can lever to 4 or 5, or and recently up to 6, depending on the nature of the business, and still drive an IRR north of 18%, the math works. It's a deal you look at. It speaks to the asset comment I think Steve made just a moment ago.
I think they still have a lot of properties that they overpaid for, and they're struggling with what to do. I don't think it's unusual. At least in our circumstance, they've always overpaid relative to what we would pay.
Mm-hmm.
Yeah, I mean, I kind of thought of them too as kind of, the bottom feeders in that, if you looked at it from a strategic synergy standpoint, a lot of times you believe you're going to get more out of it if you're strategic buying a strategic. I'm not sure that's true. And, in today's day and age, it probably goes back to my other comment that I think the strategics are being very diligent about how much they spend, mm-hmm. which allows the private equities to come a little bit above where they're at right now.
Okay. Moving to the next topic, GAAP versus non-GAAP reporting. The internet bubble in the late 90s and subsequently some of the Sarbanes-Oxley provisions were intended to try to move people towards standardized GAAP reporting, making things comparable, making things easy to compare and consistent. Yet my perception is that non-GAAP metrics are at an all-time high in companies that are reporting publicly. I've seen adjusted revenue, adjusted EBITDA, adjusted net income, adjusted EPS, among other things. Do you use non-GAAP items when you report? Why do you use them? Any concerns about the breadth of that use and that we're going to see some sort of a stiffer regulation from the SEC? Start with David.
You just keep going this direction.
I can switch.
No, fine. But I'm not happy with Jane for seating me right now, but that's a different point. We do use non-GAAP on a limited basis. So this is a kind of a religious conversation, I suppose. Personally, I think non-GAAP measures have an enormous amount of utility to investors. We get paid to be very clear with them. You guys particularly get paid to be very clear with them, tell a consistent story, and help them understand the fundamentals of the financial statements. And every one of us has a textbook on our shelves that speaks to the value of a company is the present value of its future cash flows. And from my perspective, the more I look at the filings and the requirements, particularly when you have complicated either debt instruments, we have minority interest inside of our financials, the more difficult they are to understand, the more obtuse they become. So to the extent you can help someone understand the fundamental cash flow generation characteristics of your business, help them with footnotes, and show them a few things by perhaps peeling back one layer and doing some non-GAAP reporting, I think it has enormous utility. As long as you're very careful and do the right thing, which is reconcile it to GAAP. So there's some ability to do comparables across businesses and across industries. You have to absolutely nail that reconciliation, be completely transparent. It's not a hide the ball exercise. It's a question of, I literally sent an email to my folks last night about our upcoming Q that said, we really have to get this straight and be crystal clear with investors, and here's a way I think we can set up the schedule. It's a non-GAAP way to set up the schedule, but it's setting up literally extra columns to help the investors work their way through from X plus Y plus Z equals however many earnings per share we're going to generate. I think it has enormous utility because the standards themselves are well written and well intended, but don't always help you be as clear with shareholders as you'd like to be.
Bob, this question is one that reflects the difference in the age of our company and these guys' companies, and also in my age and these two young guys here. We don't use any non-GAAP. We don't have it. And I'm blessed from that perspective because I have a hell of enough time understanding our normal numbers, much less having 2 or 3 sets to follow. But the purpose that it was intended to accomplish, what David says, is transparency is great, and you need that. But we don't talk in those terms out of our place, and we don't have to, fortunately. And the analysts that follow us, I know they appreciate that. But it really is a non-factor for us.
So we do use considerable amount of non-GAAP measures, 2 or 3 key ones focused on cash flow. I would say for our business, it's almost imperative right now in that we do a tremendous amount of risk management. We're the world's largest buyer of aluminum, and therefore just to protect that margin, we have to do a tremendous amount of hedging. It's all non-speculative hedging, but under the accounting rules, it's very, very difficult to match up what you're trying to do from an economic standpoint from risk management and get the accounting. And therefore, when aluminum prices traded from $2,800 down to $1,500, we had a mark-to-market book of about $900, almost $1 billion, and mark-to-market losses that went through our income statements of some $600 to $700 million in a couple of quarters. And you have to explain that. And so I do think it's, as David said, really important that we give the owners, whether it be debt or equity, the right picture as it relates to the financial health of the company. So we do, but we do try and be very consistent. So we don't change them from quarter to quarter. We are consistent now for I think probably 3 years in how we report and what we report on. So we're not going to throw one-time things in and out. It's really about unrealized gains and losses on derivatives. It's about remeasurement of some foreign currency type things that occur quarter after quarter after quarter that we just inherently think has to be explained. I don't want to say accounting's got it wrong, but it's very difficult to get to the right answer inside some of the accounting rules now. So we think it's very useful. I will say we are going to move towards and have a very active program underway to move towards actually obtaining, as we've matured more, cash flow hedge accounting to try and get the volatility out of the bottom line. We had, as an example, our first quarter was a record EBITDA quarter for us last quarter. But when you compare that same quarter to last year's quarter, it's lower, and it's because of mark-to-market. And you just can't get that out of the bottom line, and you can't get that out of the headlines where net income dropped, even though the base business improved tremendously in that quarter. And so we are going to continue to try and get the volatility out of the income statement, but I don't know that we'll fully ever get away from reporting some non-GAAP measures.
So just a quick follow-up. So the street then is asking for these kinds of metrics to help them understand your businesses. And do they in fact respond to those? Do they look past a bottom line that may be going the wrong way because the metrics that they're concerned about may be going the right way? And then also, are there then 2 sets of conversations, or 3 sets, 2 sets being GAAP and the street conversation adjusted? Then there's an internal conversation. And to what extent, I guess I'm asking, do the adjusted figures that you work with the street jive with what you really talk about when you sit down inside and talk about your own business strategies? And in deference to David, I'll start with Steve.
So our measures that we do report externally are very close to what we talk about internally. So there are a few other things that we just, they're too difficult to explain on a quarter-to-quarter basis, so we leave those out. But for the most part, what we talk about externally is what we talk about internally, and that's why we feel good about disclosing that from an SEC regulation standpoint, with appropriate reconciliations back, because it's what we run the business off of, and it is what we look at from month to month and week to week. So, from that perspective, we are aligned with internally what we're reporting. And what was the first part of your question again?
It was whether the street looks past those.
And the street does. I think we've been tremendously successful in getting them to understand the base business as it relates to analysts and sophisticated investors. it doesn't get away from media, and media will pick up just the headline results, and that's the unfortunate thing that you always have to get back to trying to get that volatility out.
Okay.
Again, really not applicable to us, but I can tell you from my experience over the years, you can never give the street too much information. And they'll analyze it and come back to you, and the more transparent and the easier you can make their job, the better these people's job become.
Mm-hmm.
I would give the same answer Steve gave. The non-GAAP numbers really are how we manage the business internally. Much like sort of the segment rules, how do you manage it internally? Well, we manage it off of those numbers. The street, the first time I did any non-GAAP measures about 10 years ago at a different company after a couple large acquisitions, the street literally asked me to do it. I didn't invent it to make them prettier or something like that. So the street does ask, and then that is, as Steve said, exactly what they then measure you on and what they track. I think the other thing I guess I'd say, just to amplify it a little bit, is that analysis internally on non-GAAP becomes how we write MD&A as well. We don't write a non-GAAP MD&A, obviously, but we look at the business in that way. That becomes the color you're putting in MD&A. It literally is how we run the business.
Okay. Then after all we've talked about, let's bring it all back to sort of the group and the audience here and talk a little bit about investor relations. How do you view investor relations at your businesses? How do you get the most out of it? What's the role these days of investor relations as opposed to what it may have been historically? Tell us how you think about that and how best to function as an investor relations officer for you. Let's start with Jerry, since he's been dodging all
You know,
these
it is extremely important today. It probably as much so as it has ever been. We count on Sid to keep us out of trouble. We'll do 5 to 10 visits a year. We try to be as productive in those visits as we can. We try to avoid meeting with hedge funds because they're not the kind of people that want to invest in our stock, and they just use whatever information they get to go invest in something, a competitor or something. And so we try to avoid them, but when you make these visits with the sales side people, you got to accommodate them, and their sales folks get paid based on trading volume, and hedge funds do the trading, and that's where they want you to visit. So we'll try to tie that together in one meeting, maybe a lunch meeting with 10 of them, so of them, rather than individually one-on-one. But I think that and selecting the one-on-one visits and all of that, and then getting us into Europe, understanding who our shareholders are and who our potential shareholders are, I think is critical, and having that data there and drilling down into it and helping us understand who's trading our stock. It's very difficult. Your comments earlier about is it 1 million shares that traded or one share that traded 1 million times is very apropos today. You sit there at 3:45 and you've traded, in our case, maybe 500,000 shares that day, and at 4:15 you've traded 1.5 million. And you don't know what, if it was just lights matching up or just what. So as much information as you can get in our position, the better off you are, and the better you're able to explain to the board and everybody why your stock is doing what it's doing.
Yeah, I'll give a story about investor relations and the importance of it. When we were bought 4 years ago, we were a public company before, and we were bought, went private, except for the public debt that I spoke of, and we disbanded our investor relations group, thinking there wasn't a big need to speak publicly with just public bondholders. Again, our parent company is a very large public equity company inside of India, and we missed out on a tremendous amount of opportunity over the 2 years that we didn't speak externally. It was some of the market, but our bonds traded at all-time lows. Our parent company stock traded down to all-time lows as well. And so as we thought and got more and more pressure that you need to speak not only for the bondholders at Novellus, but also to really to educate the equity guys back in India, we did bring back and form an investor relations group led by Isabel, and we've seen tremendous returns. Now the market's been in our favor, but I can tell you that the incremental investor relations contribution to our returns, both from our bonds going from mid-30s to trading over par today, to the Hindalco share price going from up almost 400% over the past year and a half is a lot to do with the fact that we've educated a lot of people that didn't understand what our strategic intent was, direction, our base understanding of the business and liquidity positions, and what's the earnings power of Novellus. So it's just a tremendous real-life example of how important investor relations are and how we saw, not having it tremendously hurt us. And now as we have to get back into refinancing, think about equity, it's just going to be that much more important that we've got that base stability back and allow us to go capture capital when we need it.
Show of hands, how many people are covered by 28 sell-side analysts in this room? 1, 2, 3. So you guys know just how important investor relations is to me. If nothing else, is the first barrier to the investors on the way here. When I think about investor relations, particularly right now, and I think Kurt said a version of this, if this is the new normal or this is a period of time where we're seeing the most challenging economy in 75 years, and the question is who's going to come out of it best, who's going to come out of it first, there is no more important time for your investor relations department. It couldn't be more strategic than it is in this market right now. You're telling a very consistent story. You're helping someone understand the fundamentals. You're trying to be very transparent, qualitatively build long-term relationships that actually do matter, even in spite of all the trading that happens. The sort of whisper qualitative bias from the sell side is still incredibly important. It drives trading as opposed to what they publish. But really those long-term relationships with the long-term shareholders that we all want to attract could never be more important. So telling that story so that they can watch the fundamentals, watch the metrics, and understand when things are either going to turn or why you're going to perform at a certain level has never been more important. It's an absolutely critical function, to the point where we actually have linked inside Global Payments investor relations with strategic planning now. So we expect so much knowledge of the 23 markets we serve that we can't imagine why we wouldn't link the two together and have IR be a core part of how we develop the next market we're going to serve, or the next market we say yes or no to in terms of an acquisition opportunity. But you guys have as important a job as I can imagine right now, and it's as strategic as we can imagine inside Global Payments.
Why don't we go to Q&A? What we will do for that is Bill is going to get a roving microphone that we can come to you with if you raise your hands. And while he's getting that and getting ready, let me ask one quick follow-up. Jerry, you mentioned European investors versus American investors, and you all three are one way or another thinking about international business, and those with the exception of Genuine Parts. Elaborate on that a little bit. If you had to go get a new investor, you'd rather have it be in Europe?
Yes, they're long-term holders. It just fits us. It doesn't necessarily mean that it would fit Global Payments, but that shareholder base fits us. Mm-hmm. And that's one of the contributions of investor relations, is that you're matching that up. And we're investing our time over there. Today, with the pressure on the pension managers and all, and get to generate returns, they will buy a stock one quarter and sell it next quarter on whispers, and that's not the nature. So it just works better for us. And you have to understand these guys are in totally different businesses than we are, and they understand their business, and they understand their shareholders and who the potential shareholders are. And that's what we're just trying to accomplish, that is match up best, and they do match up with us. We are not opposed to going into Europe at this point, but with all the sovereign debt issues over there, look, it has truly become a global economy, and what happens over there, even in an economy the size of Greece, which is really not any bigger than the Dallas-Fort Worth economy, it has a major impact on everything that's decided there, consequently coming back here to have an impact. So we understand that part of it.
Hey, Jerry, when you talk about Europe, are you talking about the UK, or are you talking about sort of the big five Western?
Big five Western, yeah.
Interesting.
I just offer one last data point, Jerry, to make you feel better. Merrill Lynch said yesterday that up to 20% of hedge funds could close by the first quarter of next year, starved for capital, and particularly the smaller ones with under $100 million. So I guess that's good news from your perspective.
Well, from my perspective, it couldn't happen to a better group. But, I feel sorry for those who are going to lose their jobs, but they'll find something else.
Do we have does anyone have a question that we could take from?
Yeah, I think it may surprise you, but we only have one of the two broken mics work.
way back in the corner. Why, just go ahead, Dave.
Yeah, Bob. Thank you all very much for the comments. How do you think about your IR investment? You know, when you're making decisions about how much or how little, how much of that spend is in-house versus external, how's your IR investment trended over time?
We do an annual budget process, and we include internal, and look, again, I apologize because we're unique. Our investor relations department is SID, and we use outside, we outsource some of that, and we use other people to provide data and tracking and so forth, but we look on it on an annualized basis, and it's not one of those, and what we've been through here, back to David's comments earlier, what we've been through here in the last 18 to 24 months, that's not something you cut back on. It's important, and it's important today as it's ever been.
Any other questions? Now, come on, guys. I'm going to let you think of one. All right, go ahead, Martin.
Just wanted to get the opinion of the panel as far as how your messaging and what you talk about with investors is different today than maybe it was in more robust economic conditions. As far as even in the uncertainty, are you confident about speaking longer term with your longer term investors that are open to that message, or are you feeling the pressure to shorten your forecasting horizon?
We actually have never given long-term growth guidance or long-term guidance, so that's unchanged. I would say your question's an excellent one because our dialogue has changed in that we're very focused on them understanding not just the long-term growth prospects for us in China and Asia and other parts of developing markets, but also in just sort of fundamentally how we perform, what the cash flow drivers are, and what to watch as we execute well through a challenging economy. So we have blended a little bit, maybe a little less selling the future of growth without quantifying it, and a little more why we're a company we think executes well through this economy.
Let me ask a question that's sort of near and dear to my heart in terms of the practice of investor relations. I am convinced that companies are not taking full advantage of technology and the internet in terms of how they communicate. Videos on the website with all of the media and information that's moving around. There are a lot of different ways to use your website these days. Have you thought about sort of different ways to approach the investor relations process other than the classic, let's fly to a city, let's sit across a desk? What kinds of things do you think might change in the practice?
From our perspective, we have to do that. I mean, the webcasting and all of that stuff is kind of old technology now. But you can't, and that's part of the stuff that we outsource, and you use the expertise there because it's not something you can maintain and build on, particularly for a company like us. But we haven't done anything on Twitter and all of that stuff that the social media that everybody's communicating on today, and that's probably where this thing will go in the next few years. And beyond that, there'll be technology we don't even know about today. But so I think it's important that you keep an open mind to what you can do in that area. Now these guys, because of the nature of their companies, they probably already doing something in that area. I don't know.
Not a lot, actually. I don't disagree with you, Bob. I think that there is more use of technology. Certainly even with road shows now, you can do it on the web and via conference call instead of having to be all over the world. But there's no substitute for sitting across the table from a large investor and taking the time to look them in the eye and give them honest answers and have a dialogue. I don't see how that goes away, actually, over the long term. So we may be a little bit of Luddites, but we're not there yet on technology. I don't intend to Twitter investors ever. Yeah.
It's tweet.
Tweet. See? There you go.
Robert?
So here's a question about board communications. So I know a lot of companies, we read a lot where some senior investor relations people present quarterly to their boards. Some never get a presence in front of the board of directors. At my company, small cap medical technology company, we do a monthly report that's kind of an operational report with a one-page investor relations update. I actually present twice a year to my board. So I guess the question is, how important is it for the board to be communicated with actively around investor relations, shareholder change, and so forth?
Yeah, I can't speak for the company I'm in because it's a smaller private board, but I'm on a board of another small cap company, and it's some of the best presentations we have actually as a board member to hear what's going on from an investor standpoint, understand what the strategy is from an investor relations standpoint. So I think it's tremendously important, especially if you have public equity, to have that interaction with the board. I find as a board member to have.
Yeah, we don't present to the board an investor relations presentation, but we do present them with an investor relations package and data on trades and shareholders and who they are and who's changing and that kind of stuff. But we don't really make an investor relations presentation to the board. It just, I don't know that it's necessary for us. We just haven't done it.
We sort of do a combination of what these two gentlemen described. We don't do a formal presentation to the board, but each quarter, post the earnings release, Jane has the pleasure of wrapping up the entire quarter, summarizing it, and sending a very detailed, lengthy email out to the board. They're desperate for it, for the same reason Steve described. You know, that these guys represent the shareholders, so knowing what everyone's thinking, knowing what's driving things. I'm intrigued at your idea of having Jane though do my financial presentation at the board from now on. So I'm thinking about that.
New direction. Yes, there's a question in the back there. Yes.
Steve, on your presentation, you mentioned that you immediately saw the return on having investor relations function as far as the price of your debt, as well as your parent company stock price. Although we all know that your stock price always is the best proxy for the performance of your investor relations function. So what type of metrics and factors are you guys looking at when you evaluate your IR program, both quantitative and qualitative?
Yeah. I think, it's still early for us. It's not even a year that we put it back in place, so we haven't put any formal review in. So I think we've looked at just kind of the impact our investor relations had on our investor base, whether it be the bondholders or the equity back in India. The comments that are coming back are so positive of the communication, the level of professionalism that we've gone to the street with. So it's a little bit, informal evaluation at this point in time, but it's what I can say is that it's absolutely imperative to have an investor relations department of a company of our size, and we've seen tremendous amount of benefits. And as we continue to grow it, we'll put more metrics in. So I don't know if these gentlemen have specifics that they look at.
I actually don't have specific metrics. One thing I do, although I've never disclosed this to Jane, but I guess she knows now, is I call the top 10 investors every spring and do my own sort of qualitative review of how we're doing on IR, communication, effectiveness, responsiveness, those kinds of things. But I haven't quite figured out the measurables. I don't know if you found some, Jerry.
No, we do use a firm to go behind us on meetings and presentations to solicit input. Listen, if investor relations and the proxy that you're using is the stock price, well, that's not very good because there's too many things that impact that stock price that investor relations can't have any impact on. So the best thing there, is you evaluate it every day. What do you think they're contributing and so forth? But we do get immediate feedback, immediate being in the next 2 months after trips and after presentations and all. We solicit that kind of input. We also have a good enough relationship with our top shareholders that they'll tell us during the meeting, you guys need to do more of this or you need to do more of that. So it's a day-to-day thing for us.
I think David and Jane will like this comment. So I've been public 3 years. We have 22 sell-side analysts. My CFO, he wants one of my measures to be to decrease analyst coverage.
I'd like to delist some of my.
When you figure that out, please come sit up here and share.
Any other questions? At this point, we've run over about 5 or 10 minutes, but let's say thank you to these 3 CFOs for their time and their.
Good morning. My name is Elliot Robinson. I'm with the Brian K. Powell Goldstein law firm here in Atlanta. I'm joined on the panel today by a terrific panel of folks. We're going to be talking about regulatory developments and how they impact your work in the investor relations area. I don't think I think it's rare that you see people this interested in SEC developments unless we're talking about football. So we're going to try to cover it. We're also going to try to be very mindful of the fact, I think many of us often speak to legal panels and continuing legal education programs. We're going to try hard not to approach it from that perspective and get too bogged down in the minutia of the specific triggering requirements and exemptions, and by drilling down too deep, and try to keep this at a very practical level that's going to be helpful to you in your day-to-day work in the investor relations area. I'm joined today on the panel by Neil Simon of the Jones Day Law Firm here in Atlanta. Neil has extensive experience in corporate governance and securities counseling for years. In addition, he also has experience as an in-house lawyer, and so kind of comes from it, but from both perspective of outside counsel and inside counsel. To Neil's immediate left, let me get my notes in front of me, pardon me. Lost my page here. That's right. Is David Bobker of Phoenix Advisory Partner, a proxy solicitation firm. David is Senior Vice President of Phoenix Advisory. They provide corporate governance and proxy solicitation advisory services to a variety of firms in different industries and of different sizes. To his immediate left, and at the end of the table, is Rob Follinis, who is the Vice President and Product Manager of Meeting Services at BNY Mellon, one of the leading transfer agent and transfer agent corporate services firms. He's overseeing ongoing development and enhancement of their meeting services division, providing a comprehensive portfolio, including proxy tabulation, solicitation, financial printing, as well as related services to all issuers of all sizes. I invite you to kind of provide any more background you'd like as we kind of go through the table. What we're going to start with is Neil's going to lead off with an overview of the key regulatory developments over the past year. We're going to do short presentations of each of the members of the panel, and then try to have an interactive dialogue both amongst the panel as well as inviting questions from the audience. So with that, Neil, would you like to kind of give us an overview? Sure. I know there's plenty to talk about over the last year.
There is. Thanks, Elliot. Thanks, everyone, for coming today. It's interesting to see this many people show up when you guys knew in advance that this was going to be a panel with at least 2 lawyers. I'm not atypical from the lawyer in that I like to hear myself talk a lot. I'm going to do my best, though, as Elliot said. Sorry. Is this effective at all? To try not to sound like a lawyer for the next few minutes. I think it's important from the perspective of non-lawyers, primarily in the audience, to discuss what is really a sea change in regulation for companies, but also understanding the pragmatic impacts that will really impact your job on a day-to-day basis. The devil is in the details of these rules. We're going to try not to get too bogged down in that unless there is a desire to do so. If there's one or more things specifically that someone wants to drill down into, please feel free to interrupt at any time. Just a brief bit of background. I've been at Jones Day practicing for 12 of the 13 or so years that I've been a lawyer, working primarily with public companies, but it's companies of all shapes and sizes. It's smaller reporting companies to multinationals. Unfortunately, the last couple of years, it's even some multinationals who are now smaller reporting companies. The point is that the regulatory developments are impacting the companies of all shapes and sizes. There are nuances and differences depending on who you are, but that means that no one is immune from some of the developments. Given these differences, and like Elliot said, we hope to have a Q&A session, but I don't want to discourage anyone from making this as interactive as possible, so feel free to interrupt with questions, comments, anecdotes, or even better real-world experiences. If this is going in and out, I'll just try and raise my voice if that's better. Okay. So I know everyone's concerned about and wants to talk about Dodd-Frank and what it's going to mean specifically for you, not only you being the company, but also even more specifically, you and your job. I want to get there, but let's just take just a second or so to talk about how we got here. Beginning in the early to mid-2000s, accountability and management responsiveness concerns by investors started to increase quite a bit. It was led by proxy advisory firms such as Risk Metrics, or ISS. I guess it's now ISS again.
It is. Go back to ISS.
ISS, Risk Metrics, ISS.
As old as new.
And increased interest by hedge fund investors, and it was a number of groups that kind of came to the table with different agendas with respect to what their expectations and desires were. It's a really interesting phenomenon, and it's, at least for lawyers, a good piece of cocktail party conversation that may have foretold some of these developments. From 1940 to 1975, the average holding period of an NYSE investment was 7 years. You had a 35-year period of stability with respect to your investors. From 75 to 1987, this dropped by 5 years to a little over 2 years within a 12-year period. By 2007, the average holding period was at 7 months, and it's dropped since then. So as we see short-term results in the 2000s start to diminish, not surprisingly, an anti-management bias developed. The late 2000 implosion of the markets resulted in a tremendous amount of new government regulation in the public company area. At that time, we as securities and investment professionals all thought that the Sarbanes-Oxley Act was going to be the high watermark for regulation. I mean, in retrospect, Sarbanes and the related SEC rulemaking weren't as bad as we might have thought. It mandated a tremendous amount of additional disclosure by companies, which was aligned with the thinking and the developments for the original Securities Act, the Securities Act of 33 and the Securities Exchange Act of 34. Specifically, Sarbanes required additional disclosures about your board and your nominees, who they were, what their experiences were, what their expertise was, board diversity considerations, the structure of your leadership, the board's role in risk oversight management, and compensation matters and metrics. But all of those were really just additional disclosures, and that's what makes Dodd-Frank so different. And I think for most of us, arguably so much more important than a lot of recent developments otherwise. It's not focused solely on increasing your disclosures. It's actually more focused on implementing new requirements for the company. And from my perspective, I believe it's going to almost force management to focus more on short-term results at the expense of the long-term focus on increasing stockholder value, which is really the charge of your management and your board of directors, which is exactly the opposite of what Congress and the regulators all said they were trying to do when they went into these rulemaking sessions. So let's talk about Dodd-Frank just for a minute. The act itself was 2,300 pages, included 95 rulemaking proposals, and the requirement for 240 rulemaking efforts by 11 regulatory bodies. 1% of Dodd-Frank related to your typical public company. The rest was all focused on financial institutions. So all of this over 1% of an act. Given kind of our time today and the limit that most people have in listening to me drone on before they're sleeping or their ears are bleeding, I think it's best to focus on the most critical provisions of Dodd-Frank for both your internal clients, your CEO, your CFO, and management, and your board, as well as your external clients, the calls you're going to get from your investors, and given holding periods, those trading in your stock. Good news, in the last week or so, the SEC came out with a tentative calendar for implementation of various of the Dodd-Frank initiatives. A number of the regulations aren't expected to be implemented and effective until the 2012 proxy season. Now, I'll warn you that if you're not a calendar year company, some of the dates may not align, and you may have some late 2011 season issues. Probably the two most highly anticipated developments from Dodd-Frank, which are proxy access and say-on pay, will be effective for 2011, and I think it's why we're all in this room today. Under the new proxy access rules, which becomes effective November 15th and applies to a company whose 2010 proxy materials were mailed on or after March 15th of 2010. So if you're going to write one thing down, I think that's it. Go look at your proxy statement, see when it was mailed in 2010. Martin, sorry. The new rules are going to give to any stockholder or a group of stockholders that chooses to act together and collectively holds 3% of your stock for 3 years access to your proxy statement for purposes of including a director nominee. Previously, director nominees by stockholders were limited in that you often saw proxy fights, which were expensive and time consuming, or depending on your company's structure and bylaws, you would potentially have a stockholder show up at your meeting, say a name, try and get that person nominated, discussed, and in a minute number of circumstances elected to your board. Under Dodd-Frank, if you receive a number of stockholder nominees for your board in excess of 25% of your board members, there are some cutback rules. So you can place, there are limits on the number of nominees that are going to be in your proxy statement. One question that often comes up is, why do you really care? Depending on your stockholder base, you might not, but effectively a stockholder can now engage in a proxy fight for the cost of a stamp. Typically the proxy fight issue and the time and expense were the largest barrier to anyone proposing a director for your board. It's going to be critical now, given that you guys as the IR department know your stockholder base. One of the biggest challenges is going to try and anticipate who, as an individual or with a group of other stockholders, meets the 3% threshold and the 3-year ownership period. One of the problems I have with the rule as adopted is that this 3% threshold doesn't give you guys the opportunity really to look at public filings of a stockholder who may be over a threshold that they've got to identify themselves to let you get out in front of them and begin to engage in a dialogue before you may get a proposal from them. The related point is now is the time to begin to work with your management, your board, and your outside advisors to consider your company's governance documents, whether it's appropriate in light of your stockholder base, your industry, or otherwise to adopt some protections or limitations that give an additional opportunity for your board and your management to focus on the long-term growth of the company and not be worried about a year-to-year issue over, am I going to retain my board seat, or if it's a down year and there's a stockholder who proposes a candidate, are we really going to have issues with respect to the vote? I can tell you that we're currently engaged in dialogue with a number of clients over what exactly they should do, whether that involves bylaw amendments, whether it involves looking at your corporate governance guidelines to consider what your director qualifications are, if you should have some specific qualifications for either one individual or the board as a whole, depending on what the composition of it is, whether you're going to end up with a really revitalized set of directors or your current composition works. A specific issue that isn't addressed anywhere in the Act, but is worth consideration, is an instance where you have